Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
We are happy to have you along. Happy Easter weekend.
It's that time.
And it is. For those of you who are not yet to Friday morning and still on Thursday, I hope you had a good Friday. It's just a wonderful weekend.
My favorite time of the year.
I call it my Super Bowl 2 weeks, right?
Yeah.
Rarely is Easter this early, but to have the Masters 1 week, right, and then Easter the following
come on,
week.
you're going to combine golf and church. Wow.
I said my Super Bowls.
Okay, all right.
Right, it's my favorite sport.
Yeah,
right?
It's true.
There is no better place than what you're going to see with the Masters Championship and the course, and it just it was just a great thing. Still sorry for Dustin Johnson, obviously, but very happy for Sergio and what a wonderful thing. But Easter, is the big thing.
It is my favorite.
Very much looking forward to celebrating that with our church family and our friends and our family. Good things are happening. It appears, Sherry, I could be wrong, but it appears that spring is here.
Yeah.
It does.
Don't say that out loud.
I did. I just did. Not only out loud, I just said it multiple times. So it's good stuff. So we're going to talk a lot on today's show about various different things and issues. We're into the second part of the fiduciary focus. So we're going to spend some time on fees and expenses, what it means. We're going to talk a little bit about how to review a trust. Sherry and I are going to talk about the expenses big time inside of mutual funds. Those also include the 401k side. And we're going to give you 10 things that are out there about a 401k that you may or may not know that you really want to be careful of. And the key thing, the thing that I would tell you about this weekend and about a lot of the stuff in most shows and most places is they have a vested interest and delivering their message.
Yes.
I do my best not to do that on this show. What I want to make sure is when you're done with this hour of your life, that you know that I know what I'm talking about, right? And that if you're going to do it on your own, you've got more tools to make it better for you.
Yeah.
Those are the two key things. So if something is right, it's right. If it's wrong, it's wrong. I've got no vested interest. When most people write white papers in the academic world, or when they're writing articles in Forbes or Fortune or Business Week, generally there's somebody who has an agenda.
Yeah.
Right? Either a research person wants this study to conclude this, or this article wants this mutual fund company to be bought, or they're either for or against. I want to give you the basics of what is going on. As I say, things that you genuinely need to consider. So anytime you have a question or comment, you can shoot us an email. Consider this at yourlifeafterwork.com. We're more than happy to have those questions. And don't forget to check out the website, yourlifeafterwork.com. We'll take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. 4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along, folks.
We are.
Hey, if you haven't been paying attention, we've been going through the fiduciary focus. I know, Sherry, it's a big word,
It
right?
is.
Fiduciary. Actually, it is becoming more and more mainstream, and people are hearing about it a lot more because of the Department of Labor rule.
It's been in the news.
It's a good thing, regardless of what happens to the rule. It's been postponed. It was supposed to start April 10th, so we're already supposed to have been there. But it looks like it's getting pushed back into June. We still think it's going to happen, and for the record, I believe that is a very good deal. We've been operating as fiduciaries since 2002. And here's the deal. We don't sell anything at the Financial Enhancement Group. That's one of the first things you have to understand. But secondly, as a fiduciary, it is my job to treat your money as if it were my money and we were in the same situation.
Legally. Right.
Though that is how I am held to task. And it's what we do for the families that we serve in more than 20 states. But obviously, most of them are here in Indiana.
And that's only because you call yourself a fiduciary.
No. It's because we choose to act as a fiduciary. We're
Right.
registered investment advisors,
Okay.
which means we have discretion over the money that we manage. So when
Right.
you come in and you put out your stuff, I start with your tax return. We go through that, what we call the family focus, which is built around the 5 critical elements: your life after work, the tax planning that has to be done before the end of the year, every year, the investment playbook, how your money should be invested. We go through the life happens, the stuff that may only happen to us once or twice, the good, bad, and ugly.
Yep.
After 29 years and thousands of families, we've been through them a lot. So we try to use that as wisdom and experience to help you. And then last but not least is the legacy plan, right?
Yes.
So the part that makes us fiduciaries is, one, yes, you can ask somebody if they legally have to serve as a fiduciary.
Well, that's my question.
And if they're a registered investment advisor and they're functioning under discretion,
Yes.
meaning that once I manage the money, I can't take it out and go to a ball game.
Right,
But I
yeah.
can tell them what stocks to buy, what stocks to sell, etc.,
Mhm.
acting, of course, in your best interest. We keep all of our money at TD Ameritrade. I think we've covered that before. Well, as a fiduciary, when I wake up in the morning and I start, there are 4 things that are always ever present on my mind. And they should be ever present on your mind if you're your own fiduciary. And in most cases, we are. 82% of the people in the industry, Sherry, actually function under suitability, meaning that they've got nice shirts and ties, and they show you pretty glossy things, and say, this looks like a really nice annuity, or these are 3 great mutual funds. But at the end of the day, it's your job to pick them. You have to say yes, and you sign off on that. And the broker pretty much claps his hands, collects his money, and
Because he's making
and
money
moves,
on
and
it.
moves right along. And
Yeah.
there's nothing wrong with making money. Trust me.
Yes.
I'm not in. I am philanthropic, but not in this. We get paid for what we do.
Sure.
The question, in my opinion, is understanding how those fees and expenses are really structured.
Mm-hmm.
So as a fiduciary, when I wake up first thing in the morning, the first thing is risk and volatility. So CNBC goes on. I want to know what's going on in the futures. I want to know what's going on here lately, the news with Syria, the new Wells Fargo scandal that just popped this morning again, where the CEO actually knew that this was going on as early as 2002.
Wow.
That's 15 years, guys.
Whew.
And of course, the Janet Yellen talking about unwinding the Federal Reserve balance sheet. Now, we're not going to talk about any of that on this show. That's not what it's about.
Right.
Those are things that you're hearing, and you can hear from plenty of other people. If you want more on that, you can sign up for our market cover. You can go to our website at yourlifeafterwork.com. I do talk about those things on the market cover because
You
they're
do?
about the market. That's the
Sure.
idea, cutting those into pieces that are understandable and going. If you want to know more about risk and volatility, though, you can go to last week's show. It's on our website at yourlifeafterwork.com or iTunes, and you can listen to the show. You can also look at our newspaper column from 2 weeks ago. It was all about risk and volatility. So last week, the newspaper column was about fees and expenses, and that's really where we're heading today. Now, let's get this out of and I'll give you the other 2 parts of the fiduciary focus so you know what's coming next week. It's taxes, both today and tomorrow.
Yeah.
And with April 15th right around the corner.
It's on everybody's mind.
It's very much on my mind, of course. And then the last but not least is real return. And anytime you hear the word real, Sherry, and in the investment world, it simply means inflation.
Sure.
So you want whatever the inflation rate is plus zero. That way you have a positive or real return. And how we manage your resources, how we help you collectively design a plan and a program really is encompassed with those 4 issues that are always there. And then around the family focus, those 5 critical elements that we talk about.
Right.
So let's talk about fees and expenses. First of all, they aren't all bad, but they do have to have a purpose that benefits you, not Wall Street. Right? That is the key thing. So there are 3 big types of fees and expenses that you will see. Right? Commissions, obviously.
Sure.
Some people are paid on commissions, and I have friends who are paid on commissions who will argue adamantly that it is cheaper for their families for them to get paid commissions than it is for me to get paid fees. Now,
Okay.
Maybe if I was just an advisor and all we did was investing and didn't do the other 5 critical elements, didn't help with the estate plan and the tax planning and everything else, maybe, but I don't think so.
Yeah.
Yes.
Commissions on what exactly?
Commissions on anything. Could be on an annuity.
Like,
Could be on a life insurance policy.
so it's not
Could be on
uncha-
selling a mutual fund.
Is it like a stagnant thing, or like every time you buy and sell, or it's like
Every time you buy and sell. Now, the SEC and FINRA have really cut down on that, but it's a practice called churning. Churning is when an annuity salesman will get you to move money from one annuity to another annuity
Yes.
because the surrender penalty's over, purely to get a commission.
Wow.
Or a life insurance policy to another life insurance policy.
Right. Yeah.
Or from one mutual fund to another.
Right.
That's called churning. And if caught, bad things happen.
Sure.
Right. So you've got commissions, you've got internal costs that go on. So like annuities that sound really, really special on the outside have a bunch of costs that are on the inside.
That you can't see.
Some of them you can see and some of them you can't.
Really.
So that's why I call them fees and expenses.
Okay.
A fee, Sherry, is like buying your house.
Right.
You knew what it cost when you bought it.
Mm-hmm.
Now, you're a bright lady.
Yes.
You knew you were going to have to mow the yard.
Yes.
You knew you were going to probably have to replace a roof, a water heater, carpet, paint the walls, right?
Yes.
But because it wasn't quantifiable, even though you knew it would occur, because it wasn't quantifiable and you didn't know what it was at the beginning of the year, nobody told you how much it was, which makes sense.
Sure.
The problem is in my industry, everybody knows that the expenses many times are actually even greater than the fee.
Really.
Like in an annuity, for instance,
Okay.
it is very typical for the salesman on a variable annuity to get a 5.5% to 7% commission for selling the product. Right? He gets
Okay.
that one time essentially, or takes it over a period of years.
And would I know that as
You-
the customer? As
You
a
don't know
client?
it now. After the Department of Labor rule, the person functioning under suitability would have to
Tell
put it in
you.
front of you and tell you even before the discussion started.
Wow.
Right? So imagine this being a bad concept, right?
Right.
You know,
Yeah.
if the guy on this side of the table is going to get paid $5 to $7 grand for you saying yes,
Yes.
it's probably a pretty good idea that you know that up front.
I'd like
right?
to. Yeah.
Now, doesn't mean it's bad.
Mhm.
That's not what I'm saying. But we need to know what those things are. And
Sounds like
that's-
full disclosure to me.
it does. It
Okay.
does. So, but inside of it, then you've got more fees and expenses. And mutual funds are the same way in terms of what happens inside of it. Now we're going to come back and we're going to talk about the trifecta.
Okay.
It is the worst of the worst of the worst, and we'll take a break and come back. So the trifecta is an advisor who charges fees
Okay.
for what's called a wrap account. He takes your money and he puts it in mutual funds that have their own fees and expenses. Even though he's no longer getting a commission, he's getting it off the wrap account, right? But you're still paying it. You're paying the advisor, you're paying the mutual fund manager, and guess what? Even though exchange traded funds are cheap, the mutual fund managers are the largest owners of exchange-traded funds on the planet. So you've got a fee, and a fee. I call it the trifecta. It's ugly. I got to take a break. Sherry and I'll be right back to talk about more. Shoot me an email. Consider this at yourlifeafterwork.com. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. The show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
We are plumb tickled to have you along. I hope you're enjoying your wonderful day, whether it's Saturday morning bright and early, Sunday morning, Thursday evening, Monday evening, whenever it happens to be, we are happy to have you along. And of course, on iTunes or our website as well at yourlifeafterwork.com. We're talking about the fiduciary focus, and this week's focus is on those fees and expenses. And I really want people to get a handle on them. And I could spend, in fact, I spent a week when I taught at Purdue on the expenses inside of annuities and the expenses inside of mutual funds. So we're gonna spend our time right here on mutual funds real quick, just so you understand. And when we talk about a mutual fund, remember they were created in 1924, and the last major overhaul. I know this is going to shock you, but Sherry, we're in 2017.
True.
When do you suppose the last major overhaul on mutual funds occurred?
Maybe 5 years ago, 8.
That makes sense, right?
Yeah.
Almost everything we have in our lives changed in the last 5 years. Yeah, 1940.
Woo!
The Investor Act of 1940. So when what happens in society, especially with stuff that you don't live and die with, right? I live and die in this world, so I'm aware of all of the changes. Most people don't, right? Most people don't. And so we make decisions, we get caught in those decisions, and we don't ask any differences in terms of what's happened, right? Now, one thing that has very much happened in the mutual fund industry over the last, let's say, 10 years is people have gone from more active management, where you have a manager who's constantly buying, selling stocks or bonds or both, to passive managers. Think the S&P 500 index at Vanguard, more passive funds. And we're seeing that. And when you go to passive, you do begin to eliminate some of the fees and expenses. That is a good thing.
Because you're not paying a manager, you're just buying.
No, you're still paying you're paying the custodian for all intents and purposes to hold the shares. There's no active management decision that's going on internally.
Right.
And as a result, there's no trading cost. Right.
Mm-hmm.
So the operation or the premium is much, much higher. Now while we're there, it's called a drag, right? Mm-hmm. We look for anything that drags on people's financial world. Any costs that are out there that drag your returns down. My focus is always going to be on your tax return, because I think that's a permanent drag. I started in this industry 2 weeks before the crash in '87, right? So I've seen that crash, the tech wreck, 2008. And I watch markets go up and down, and it's a vicious volatility at times.
Right.
But over my career, it's always worked its way back up. Mm-hmm. Right. Historically, it's always worked its way back up. When you send a check to the IRS this weekend, it ain't coming back.
No.
Right. That money is it's gone. Right. And so our focus is in my world is going to be as tax efficient as you can.
Makes sense.
One of those ways to be tax efficient is to use passive type investing.
Okay.
Now, I want to move over and talk about the different share classes that exist inside of mutual funds, just to give people an idea of really what's going on. And Sherry, there are essentially 3 different shares that you can buy from an advisor: A, B, or C. Mm-hmm. Right? A shares, you're going to pay a commission up front.
Okay.
A B share, you're going to pay a higher internal cost. The mutual fund company, whether it's American Funds or, and somebody told me they don't even have B shares anymore. Honestly, I don't know the answer to that. But the B share, whether it's, Putnam or whomever, they're going to front the sales guy the money, and they're going to charge you more money internally. And if you decide to leave early, they're going to whack you. So it's a deferred sales charge.
Okay.
A C charge is going to tend to have a higher internal cost. But it's but you can leave anytime essentially.
Are you going to know any of that though?
Yeah. They have to tell you that. You know whether it's an A, B, or C share.
But the mutual fund is that's all going to be a manager's.
These are different ways to pay the same manager, Sherry.
Wow.
So the manager doesn't give a hoot.
Right.
The manager doesn't care. He doesn't see it. This is the sales guy with the bright shiny thing.
Okay, I got it. I got it. Yeah.
So all mutual funds are priced daily at what's called NAV. That's net asset value. And then they have charges that go against them. So in my world, there are shares that we can buy institutionally because of what we do. There are shares that some people can only buy at NAV. That means there's no sales commission. And then most people buy A or B shares. So just to give you some examples, in a bond fund, in a municipal bond fund, let's say you went and bought it. Once you've paid the commission, that's an A share, right? So you've lost your 4.5%, depending on how much money you put in, the lower the percentage is, but it's usually 4.5%. You're going to pay in an average municipal bond fund 0.82% per year after that. That's the internal charge that's going on, what we call a 12B1 fee.
Okay.
And that 12B1 is for marketing, distribution, right? And other things.
Yeah.
And it does not count trading cost. That's where it gets to be really, really interesting. So it's 0.82 is what you're going to pay if you're going to pay your commission up front.
Okay.
If you're going to defer it, you're going to pay 1.52%. Right?
Man.
1.52. And then after the 5 or 6 years, whenever the deferred sales charge runs out, by law, they're supposed to revert back to an A, right? So they go back to a cheaper thing. Now, if we bought it at NAV, right? If we bought it at net asset value, the average muni bond fund is at 0.6, right? So it's 22 basis points cheaper than what the average A share is, right? If you're able to buy it as a registered investment advisor. So when people say, okay, does this make sense? Well, there are registered investment advisors. I am not one of them that use actively traded mutual funds or mutual funds, period.
Right.
We do not have open mutual funds in our portfolio. I don't see the point of spending 0.6.
Right.
In getting this done. Now, moving right along to institutional. What's institutional? Well, it's a pension fund. It's your 401k if it's a big enough place. In the muni bond side, it's also 0.6. Not a big difference, right? Moving to what we would call allocation funds. That's when you have a manager who has got multiple disciplines, right? Let's say it's a moderate allocation, so consider yourself balanced. If it's a front-end contract, so you've paid the manager the commission, you've lost 4.5% out of your account, you're going to pay an additional 1.2% a year typically in terms of a cost inside of 12B1 fees. 1.96 if it's deferred, so almost 2% a year that's coming out, right?
Yeah.
If your account is over $250,000, we charge 1.5% a year, and that includes the financial planning that goes on top of it.
Yeah.
And you're paying this mutual fund manager, a guy in Boston that you're never going to meet,
you're never going to see
2% a year. Yet there are lunatics that are out there that will tell you that commissions are better than fees, and it's because they only talk about the part they get.
Yeah.
Right?
Can I ask?
Sure.
Okay. So retirement. Let's say I have a retirement fund and it's all mutual. I just buy into that. I know, but let's say I do. I don't, but let's say I do. Am I going to know any of that when I get my statement?
All of that. You get those prospectuses, those big long books that are written in 6th grade language.
I'm saying, where am I going to find that? Because
it's all laid out in there.
It'll say that. It'll
Absolutely
say
will say that.
Wow.
Anything that is quantifiable has to be there. The problem is, I am probably the only person talking or listening to this radio show right now that has actually read one. Right?
Well, that's
Nobody does, but the data is indeed there.
So what I'm going to do as the person who has a retirement account is look at the number. What's my bottom line? Did I go up or down?
That's what everybody does. Here's the key thing, Sherry, because we got to wind this up.
Okay.
But the key thing is the person in the bright signage, the tie and the pretty shoes, tells you what they get paid.
Yes.
And anything beyond that is just beyond that. And that's the whole reason of the Department of Labor rule. My job as a fiduciary is not to worry just about what I get, but worry about what you pay.
Right.
Any drag that's on the portfolio. Under suitability, the job is to make sure that I sold you something that fit into the shiny box that made the SEC happy.
Wow.
Enough of that. We got to move on. We are going to carry this conversation on into 401ks, though. You're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We'll take a break and be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
So happy to have you along, Sherry.
Yep.
You know, it's a wonderful world, and we're going to talk about one of those wonderful ways to save for retirement. Most of what I'm going to say in this segment is true if you're in a 401k or a 403b. 403bs are for people working not-for-profits, hospitals, universities, churches, education. And if you're in the private sector, you have a 401k. Not all of the rules are the same, but many are very similar.
Okay.
So found an article that essentially said the 10 biggest 401k plan misconceptions. I read through the first 3 and go, this guy and I would probably not exchange Christmas cards.
Really?
So
I thought
we would just let you have at it. Let me say one thing about a 401k before I start. Because the biggest misconception that I find in my career is not any of the ones that he listed.
Really?
I hear people on the radio all the time, for instance, say that you can get a loan, and he talks about loans in the 401k. The Department of Labor creates the big circle, if you will, the rule tank, right? The rule tank says that you may indeed have loans in your 401k, right? But you have a plan document at your company that then can't be any bigger than the Department of Labor circle.
Right.
I can't add rules like you can take money out for bubblegum.
Sure, right.
But there's rules. I don't have to put all of them in.
Really?
For instance,
okay.
We have a Roth option in our company, in our 401k plan. Only about 22% of 401ks today offer that. I can't tell you why. It's ridiculous. They all ought to. I can use exchange-traded funds in my 401k, which, as you know, are much cheaper and much more transparent. Why people use mutual funds, I still can't answer that, right?
Yeah.
We've got 19 people on our team, and I can afford to use exchange-traded funds, but apparently other people can't. You might kind of wonder if there's a little bit of something in cahoots going on. That's just me saying.
Yeah.
Right? I don't want people to use my 401k plan at our company as a put and take account. So we don't allow loans.
Yeah.
Right?
So you don't have to allow loans.
That's correct. It's based on what your plan document is. So please don't get in a trap when somebody says, here's what it does. So go ahead, Sherry.
Okay.
We can fire away.
First misconception, I only need to contribute up to the maximum company match.
How does anybody know? Right? First of all, always take free money.
Right.
Oh,
yeah.
So bottom line is always put in enough money up to the company match.
Right.
But I have seen in 29 years of doing this, I have watched people who have saved a lot more money than they should. And I know that may sound ridiculous, but if you're if you're living life just for a 401k, then that's problematic too, right? If you're 21 years old and you're already able to sock away 6% plus getting the company match of 3%, right? There are other things that you probably need to be working on, like an emergency fund, right? Making sure that you've eliminated all of your student debt, et cetera, et cetera. It's not, there is no white box that says, here are the rules. We are all unique. God made us that way, and we have to look at your situation.
Yep. Okay. Well, number 2, and we just touched on this, it's okay to take a participant loan.
He's going to talk, and I'm sure use the terminology of account leakage. That's
it does.
where they are.
Mm-hmm.
I'm not a big fan of the loans, but there are periods of time where they make sense. You pay the interest back to you. It's a lower amount of interest. So if you finally got yourself in a committed point to where you're not going to do credit cards anymore, and you've got a 25% credit card, and you can't get it financed anywhere else out there, and you're eligible to take a loan, then I can't tell you that it doesn't make sense not to do that. If you're expecting 25% a year in the market, you're better than me.
Yeah, that's true. Good point. Rolling a 401k account into an IRA is a good idea.
Now, this is one of those that all depends. He's going to tell you, and most 401k people will tell you that never makes sense, because they talk about the institutional funds, and most individuals are not going to be able to get an institutional rate. So if you're going to roll the money out of the 401k to an IRA with the guy with the bright tie and the shiny shoes, then that's probably a bad idea for you. From a creditor and bankruptcy protection in Indiana, they're both the same now. It doesn't matter if it's in a 401k or an IRA.
I see.
But if you're going to roll it to somebody that has a process and is a registered investment advisor, In many cases, it does make sense to use the IRA because you opened up a much larger opportunity of the things that you can invest in.
Yep. My 401k account is a good way to save for college, a first home, et cetera, et cetera.
People talk about that and use them for the rules. You can borrow money out of a 401k if you're allowed to for a first-time home buyer and pay it back over a period of time longer than 5 years. Whereas if you take a normal loan, it's got to be paid back over a 5-year period of time. Is it good for college planning? No. First of all, the money belongs in Indiana College Choice if you live in Indiana first, because you get the 20% tax credit up to $5,000, so you can write $1,000 a year off your taxes. I would not use the 401k for college planning.
I should stop making 401 contributions when the stock market crashes.
Absolutely not. If you've been here long, you know we talk about the 3 phases of finance: accumulation, preservation, distribution.
Yeah.
Right? You're still putting money in, and the beautiful thing about a market volatility is when you're buying stuff when it's down. Like I said, over the many, many years of my career, it has always gone higher. It just has a lot of volatility in between.
Now, what if
you're at retirement time, this is a different story.
That's what I mean.
You shouldn't have been all the way in the equity market. And the portion that was in equities, no, you still shouldn't cut bait and run. It's too late at that point in time. You should have been using risk profiling based on your needs and where you are along the way.
Okay. Actively trading my 401k will help me maximize my account balance.
Not for most people. One of the things we know is the more choices they have, the worse the average participant does.
True.
Right? And trying to move back and forth, if you're not a professional and paying attention to this, it generally does not work out for better returns. I'm also not a big fan of the quarterly rebalancing. We've made a lot of money off of people who do that.
Yeah.
So essentially, we're taught in the good word, right, that you give to the one who did better, and you take from the one who did worse. Isn't that kind of the story?
Yeah.
So rebalancing in a 401k plan does the exact opposite. If the large caps did real well and the small caps did poorly, you take from the large and give more to the small, and under the theory that you're buying on the cheap. Doesn't work in my world, but that's what that's about.
Okay. Indexing is always superior to active management.
Has been lately. Only 8% of money managers the last 3 years have outperformed the passive. Passive is always going to be cheaper, but you can never, in our world, you can never say never.
Right.
Nor should you.
Okay. What do you think about target date funds are not good investments?
They are not good for people who have access to money managers who can do things. What happens in a target dated fund is you have a manager that oversees the managers, and based on modern portfolio theory and some long-standing beliefs in investing, they move your money around based on the year that you think you're going to retire. So the closer the year is to you today, the more fixed income you will have. The further away it is, the more equity you will have.
Money market funds are good investments.
They're not going to give you a lot of return, but they have no volatility. That's why we talk about the fiduciary focus, right? It's a mixture of stocks, bonds, and cash, and you have to have that right mix. Putting all of your money in there, you're not going to have any volatility, but inflation is going to eat your lunch, and your retirement is doomed.
Yeah. So here's the last one. I can contribute less because I'll make my investments work harder.
Now you're dreaming, right?
Yeah.
We all have a part to do. The money manager's job is to make it grow. Your job is to save the right percentage.
Right.
Right. And the two of us working together have the responsibility of trying to make sure that you do have a life after work. Right. That's really what we think at the Financial Enhancement Group, that it's about your life after work. So remember, that's not just winning in the first quarter. That's not just winning at halftime.
No.
That's not winning. That's winning when the buzzer goes off and the game is over. And you just saw a lot of sporting events this week where, not to mention the Masters, where that last shot is the winning shot. You did learn a little bit from Sergio Garcia, whether you're a golf person or not, and that is never, ever, ever give up. Even when the ball is out of bounds and you've got to drop it, stay true to the vision and stay focused, and you will get there. My friends, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We got a lot to talk about, but we're getting ready to go into this next conversation, and we're going to talk about trust, things that you need to know and that you need to understand. We'll take a break and be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along.
We are.
Hey, if you're not familiar with the Financial Enhancement Group, here's the deal. There's 19 of us on the team. Nobody gets paid commission. Everybody works together in the best interest of what they have. So I have an allocation team. We're the ones that manage the money. So Adam Harder's my CFA. He does all the fundamental work. Andrew Thrasher is my chartered market technician. By the way, the youngest winner ever of the Dow Award.
That's cool.
The Charles Dow created technical investing back in 1893. And very, very proud of Andrew for that. And then I take care of the macroeconomics, and the three of us really build the portfolios and the allocation team. The planning team is a group of the five of us that are advisors, every one of us enrolled in or already a certified financial planner designation. And we discuss the cases that we take care of to make sure that everybody's in a good situation. Mm-hmm. So I am very much a big fan of Checklist. I don't know if you've read the Checklist Manifesto yet or not. It's probably one of the most influential books for me that I ever read.
Yeah, you've mentioned it before.
And so when I sit down and I have an issue or a situation, I always build a checklist. And then if something arises that's not on that checklist, that the checklist didn't address, we add it to it.
Add it to it.
And so I've got one that I put together just so you don't miss anything to help them review a trust. So people will often come to our office and say, Joe, do you help with that? Well, help, yes. Do, no. I am not an attorney. Don't play one on TV or radio. That is not my job. Now, I do have a benefit. Most attorneys spend their days reading their own documents, right? I've got more than 600 families we take care of with many, many different attorneys. And so I've read a lot of different documents. I still don't speak legalese. But there are some good ideas, you might say, that I find in one trust or another that I can help you say, hey, why don't you ask your attorney about this question, right? So our job at the firm is to make sure that the trust says what you want it to say, to help you keep that part of it updated,
right?
And to make sure that your stuff is owned correctly after you have a trust. So there's key things to identify, Sherry, when we have a trust when it comes in. The grantor, all right? So in the world today, you'll hear people use the word living trust, right? Or grantor trust. Also inter vivos if they want to impress somebody. But it's usually grantor, and that's the person who's transferring their property into the trust. Now, when that's done, most trusts are revocable, meaning I call it the hokey pokey, right?
Okay,
you can stick your left leg in, shake it all around, pull it back out.
So I put money in, I can take it out.
Money, assets,
Anything
but your IRA and your 401k, you can put in your trust.
Right.
Undies, socks, shoes,
Yeah.
cars, homes,
Okay.
savings accounts, brokerage accounts, right?
Sure.
The trustee is the person who's in charge.
Okay.
Now, generally, that is the same person as the grantor, right? And you want to make sure that it's there. Sometimes it's husband and wife. Sometimes it's just one of them. The name of the trust, I have every now and then people get upset. Why does it just say the Joseph A. Clark Trust? Well, it doesn't matter if it says the ABC or the Flim Flam Trust, right? That's not what matters. It's who gets the benefit, right? The trustee part does matter. And the best way that I know how to explain this to people is I can either make it work like my checkbook or I can make it work like my house. Right. So Barb and I are the trustees of the trust. Right. And we can either act independently. Either one of us can write a check out of the checking account. Right. I do not have to, trust me. I don't have to put my name on it, and Barb can still write the bloody check.
Right.
But if I went to sell my house, if it wasn't in the trust, it takes both of our signatures.
Sure.
So you can make the trustees have to act together. Right. So they're always on the same line, or they can act independently.
Do you always have two trustees though?
No. Many times you do not.
Right.
You should always have an odd number, in my opinion, however.
Yes.
It should be one or three, never two.
Never two.
Because then you can get caught in a stalemate.
I got it.
The successor trustee is who takes over when the trustee or trustees are no longer able to fend for themselves, right? And so you want to know who those people are, and then you want to know who the beneficiaries are, both during life, right? That's usually, again, the grantor and the grantor's spouse, and then who the beneficiaries are at time of demise. Now, the key thing here is we want to make sure that the trusts were actually funded.
Right.
I had somebody come in the other day and they brought in $1 million account from a brokerage firm, and it clearly said husband and wife.
Right.
And I got down my checklist and I said, so you haven't done any estate planning yet? And they kind of, well, yes, we have. I go, oh, what do you mean you have? And she goes, well, we have a trust. And I go, well,
what's in the trust?
Did you bring the trust? And they brought me the trust, and it was 3 years old, and it was reasonably updated. It didn't have a trust protector clause, which I always recommend. But other than that, everything seemed to make sense. And I said, so why isn't the brokerage account in the trust? And they said, it is in the trust. It says right here that the assets from the brokerage account go here. And I go, but my friends, it doesn't get there. You've got to put it in the trust. That's called funding. And that's one of the things that we make sure of at the Financial Enhancement Group that's always done. That if you have a trust, that it is properly funded, that your assets have been transferred. We make sure that your attorneys followed up and done that with your house, that you've done it with your cars. The key thing in Indiana, and pay attention to that being Indiana because each state is different. When I kick the bucket, when God calls me home, the key is to have less than $50,000 in my name, right?
Okay.
So the rest of it has to be in a trust, assuming I have more than $50,000. It has to be in a trust or jointly, something like that.
Something, yeah.
That way I don't have to go through probate, or my family doesn't have to go through probate on my behalf.
That's a good benchmark, I think. I mean, that's a good quantifiable goal.
But you want to make certain, though, that everything is funded, and that's probably the most missed thing I see.
Okay.
The second most missed thing I see is, are there any charitable bequests that are inside of the trust? Many times people will say, hey, I want to leave money to this church or this university. Just charitable intent. And they don't pay, the attorneys don't necessarily pay attention that there's an IRA or a 401k plan that's out there.
Right.
Bottom line is the charitable bequest should come out of tax deferred money. Charities don't pay tax, right?
Right.
They should be receiving money that's not going to be taxed now because it came from there. Right. Whereas money you left in the trust is money that you've already paid taxes on, and now your family could be getting tax-free money, right? As opposed to tax deferred money. Make sure that the bequests are in terms of percentages, not dollar figures. That was one of the big things that we saw that came out of 2008, especially out in the East Coast when, states had $20 million and suddenly they were down to 5 or down to 2 because they got caught up in a real estate deal. Well, if you got a trust that says $1 million goes here and $1 million goes here and my kids get the rest, the kids don't get any.
Right. Yeah,
because
yeah.
the specific bequest goes first.
Wow.
There are 5 assets. We talked about funding, but there are 5 assets that I always have the planning team look at to make sure that are funded. So if you miss this, you can always go back and review it on our website at yourlifeafterwork.com. But the 5 are taxable accounts, whether they be in a bank or whether they be at a brokerage firm. Tax deferred accounts. Attorneys will say put everything in the trust. Remember, Sherry, you said everything goes in my trust, and I said not IRAs and not 401ks.
Right. Yeah.
Right? So you want to make sure that they aren't. You want to look for tax-free accounts. Make sure that the Roths have the right beneficiaries on them, not owned by the trust. Life insurance and real property are the other 2 things, like your house and life insurance. They can be put into the trust. The life insurance, obviously, you make the trust the beneficiary if that's what you want. All 5 of those categories have different tax consequences. That's why we have to look at them. And there's a lot I'd like to share with you on how we set up the distribution. Not all beneficiaries are equal. Not all kids are the same.
Yep.
And we get into some very crafty stuff in terms of making sure that our families are really distributing the money the way that is in the best interest of their family. So I hope that gave you some good insight and some ideas. When you come in to visit, it's one of those areas that we go through of the 5 critical elements: your life after work, tax planning, the investment playbook, life happens, and the legacy planning, which is more than money. For our friends at WIBC, we wish you a very wonderful Easter. Have a great weekend. It is April 15th, but we got a couple-day reprieve because it falls on a Saturday. We appreciate you tuning in. If there's any questions or comments, you can shoot us an email. Consider this at yourlifeafterwork.com. And, of course, if you want more, you can get the 5th segment on our website at yourlifeafterwork.com or, of course, iTunes. Have a great week, my friends, and again, happy Easter.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana, with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along.
Yes.
I swear this is still the fastest hour on radio.
I know, it flies by.
We're moving into what we call the bonus segment. One of our stations, we only have 4 segments, and you guys get to hear the 5th.
So special.
Well, of course they are.
Yeah.
We were around these other stations much longer than the new one, anyhow. So anyhow, this is Sherry's portion where she's able to say, "What say Joe?"
Yeah.
She brings a topic. I'm not allowed to know what it is, which creates some interesting things because sometimes we have overlap of things that I talked about and things she wants to talk about.
True.
So she was a little worried about the last segment over the estate planning.
I think you did pretty good, though. I don't think you stepped on me too much.
I tried not because you warned me.
I know I did
so
warn you.
Go ahead. It's your show.
Okay, so sometimes I pick things that I think I want to stump you on, and sometimes I pick things because they're pertinent to either my situation or people I know. And this is one of those cases. So we've talked before about what to do with as people get older in terms of financial planning. And so I found an article recently that talked about how many of us are in that sandwich generation or that sandwich part of life where we have elderly parents. We also have children. In my case, I have grandkids too. So I have 4 generations of people that I kind of look out for. And how do you navigate that in terms of as the people you know and love are getting older and you want to make sure that the right things happen? In this article, it said they suggest that financial decision-making ability declines after age 53, which I thought, whoa, that's pretty young, because a lot of people who are 53 have parents that are living that
Absolutely.
are much, much, much older.
So let me help him out because if that's what it said,
Yes.
that's not what the neurologists say to be true. What they do say is at 52. So I'll buy 53 if you want to use that. That
Sure.
gives me another year.
Okay. Yeah.
What they do say is you begin to rely more on rule of thumb rather than new data.
Ah.
Right.
So what you're used to.
So there's a difference. Correct. That.
Okay.
I've got a family that I've taken care of for 28 years of my 29-year career, and their parent is in his 80s and has a mutual fund portfolio. And
which you dislove.
The kids are looking at him going, "Listen, Joe explained to us years ago why you shouldn't be here."
Right.
But there was no such thing as exchange traded funds, in his prime when he was making decisions.
Right.
And it's just hard for him to wrap his head around it. As a result, countless fees are going out the door for no reason.
And I've had this conversation myself.
Yeah.
I mean, so my question to you is, first of all, these conversations are hard to have if you have people.
They are.
And at what point do you have them? And I know that when you work with families, you do actually deal with this. So at what point do you have these conversations? What are the signs to look for that you need to have them? But I think the point in the article I made was you don't want to be in the midst of a crisis.
We're going to actually have Secretary of State Connie Lawson on a segment with me talking about elder abuse, and some of these things will come up.
Okay.
The question is, when do we first talk about it? The day is that I meet you. And some of my younger families that come in their 30s or 40s think it's odd.
Sure.
But we're so into the habit of doing it. Here is the question. We talk about the family vision, right?
Right.
2 sentences of a non-quantifiable, meaning it's a qualitative statement about who you are and where you want to go in your words. Right?
Now, wait a minute. So when you say in your 30s or 40s, you're talking about them.
When they come in, it doesn't matter what age you are, we're going to ask you your financial vision so that we can help you articulate it in your words so that when I believe you are slipping,
right,
when you ask for $100,000 to go buy a brand new Corvette and you used to clip coupons,
Right.
I have the capacity to give you in your own words what you had once said before.
Sure.
To try to make sure that you're on the right track.
So I get that, but what if they're concerned about their parents, not them?
That is a whole nother conversation. That
I know.
When you in the key thing is you try to have people do stuff early.
Right.
You try to have people document, why they did it. There's an old business saying that anything that is measurable should be, right? So I always ask people and would help them, why is your money at the Financial Enhancement Group?
Right.
Why did you choose to be here? Of all the places you could go, what was it that made you fond of what we did?
Sure.
And I do that for a couple of reasons. One, it lets me know what matters to the families we serve.
Yeah.
Right.
Yeah.
So that I know to go through and look at. For instance, there is a survey that just came out. My job as a money manager, I perceive my job is protecting you from risk, right? And that's really one of the reasons Adam and I do what we do. We are very protective of the families that we serve. The survey that just came out, not surprisingly to me, but surprising to a lot of people, was the clients care about growth. Because the last 5 years, they haven't needed risk protection. 2008's in the rear view mirror.
They're not
right?
even thinking about it.
They don't even think about the tech wreck anymore. So their mindset now is, how do we grow this thing?
Sure.
Right?
Yeah.
And my mindset is, hey, how do we keep this from falling apart?
Right.
Right. Still have reasonable returns, without getting ourselves into mischief.
Right.
Right.
So, okay. So on our show, we normally talk about exactly what you just said. The families that come in, how to service them, and maybe their kids and their grandkids and their estate planning. But what I'm asking is,
I understand.
Yeah. So I come in and I'm like, okay, what are the questions I should be asking the generation ahead of me? How do I make sure that they're okay, even though they're not my responsibility, but they kind of are? I'm that sandwich generation.
We strongly encourage people by the time they are 75 to have everything laid out.
Okay.
I tend to look at people and tell them the documents that we're working on today, hopefully you won't die with.
Right.
Right. I mean, hopefully there are enough changes in the next 50 years of my life that the documents that I pay dearly for today are meaningless. Right. That I'm going to have them updated and redone. And I know that, in fact, one of the attorneys we work with in Indianapolis restates all of your documents every 2 years.
Right.
Right. Now, some people might say that's overkill. So I've seen a lot of bad stuff happen. It kind of makes sense to me, for some families to go through that process. But you tell the kids that you need to have this done by 75. And then there are key things that you want to ask, right?
Okay.
If something were to happen and you had to go to a facility, do you have one that you would prefer to go to?
These are the questions you're asking the generation older than you.
This is the checklist that I would give if you said, Joe, I have to go talk to my parents.
Right, exactly.
That's
what I mean.
They still have all of the sandwiches and they're ready for the picnic.
Right.
But one could disappear at any moment.
Right.
One sandwich.
Right. Mm-hmm.
Because again, with estate planning, when people ask me to help put together a trust, it's almost always, so if I die, this happens. And about 10% of us just die.
Right.
90% of us truly fade away. And so the most important thing in that document is how we care for you after you can no longer care for yourself.
Which is probably
mentally
pretty
or
complex.
Physically.
I mean, it's not just a simple long.
It's not something you just want to spitball, right?
Okay.
I mean, you want to have this as thought out and as well thought out as you can.
Okay.
Which is why we try to encourage people to do it by the time they're 75.
Right.
Right. To make sure that because that one is when we're usually starting to not think as deeply as we possibly could. We may change our opinions over our kids. Right. In terms of what percentage goes to which one or how that's done. But the rest of life stuff is pretty normal. But building that checklist of the things that matter, who takes care of you if you can't take care of yourself, who determines that,
right? The proxy.
In a trust, you get to figure out, you get to determine who you want that to be.
Right. Yeah.
And outside of a trust, any property that you own in your own name, for instance, a judge and a doctor can say, Sherry, dear, you're incompetent.
Yeah.
Right? And I'm not happy with that ball game.
So people need to come see you and get this checklist.
Well,
is what I'm saying.
That's rather self-serving. But
I know, but I mean,
you just need to think through what all of those things are, and
right.
and the things that we would do for the families we serve, are the things that they need to do
or
help the parents in front of them. We've been doing it for a long time, and we think these things through the lens, through the eyes of many, many different families.
Got it.
Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We got to take a break. We'll be right back. In the meantime, question or comment, shoot me an email. ConsiderThis@yourlifeafterwork.com.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
I hope you enjoyed the fastest hour in radio.
Man, it flies.
It every Monday morning I get to come in and do this show, and it is an exciting thing for me to be able to do, to talk to you folks, to take the stuff that's happened over the weekend and really
make it make sense.
Make it make sense. And I'm enjoying this part about the fiduciary focus. I hope you're beginning to absorb what that word fiduciary really means. I have to take care of your money as if it were my money and we were in the same situation. And not to pick on Wells Fargo because they're under the spotlight, but you heard about all of the bank accounts, all of the stuff that was opened up and stuff that was done.
Wow.
If the Department of Labor rule existed, most of what they did could not have occurred. Right? If the people at Wells Fargo were functioning as fiduciaries, most of the stuff that happened would not have occurred. So does that mean that everybody at Wells Fargo is bad? No, of course it doesn't. Here's what it does mean. You deserve and need to be working with fiduciaries anytime you get the chance. You want the person who is helping you with your resources be on the same side of the fence. And if you ask them if they're a fiduciary and they say no, or they say, well, the people inside of the mutual funds are fiduciaries, or that we have fiduciaries, those are all bad answers. Right. You know, if I could have a shirt and a flag made saying I'm a fiduciary, I would hang it. I spend a lot of money. I go through a lot of protocol, a lot of excess regulation, because we believe so desperately that you deserve somebody on the same side of the table making decisions for you, for your money, for your resources. Everybody on our team is a fiduciary. You know, and we take care of people who don't want to worry about their money, and we've structured this whole operation, this family of people that we call the Financial Enhancement Group. We've structured it to make sure that we're constantly aware of risk and volatility, that make sure we're managing the fees and expenses correctly, paying attention to your taxes both today and tomorrow, and making sure that you're getting a real return on your money. That means something above zero plus inflation. That's the job of a fiduciary. And if I'm doing something that lines my pocket or works for a quota that somebody else told me that I had to do, you know, I know we all have to have jobs, but guys, you're working too hard to save and accumulate for your retirement to worry about that. You need to be at a place, in my opinion, that has no quotas, that their only job is to take care of you and to do that in a fiduciary light. Now, with that, I hope you have an outstanding Easter.
Yeah.
You know, April 15th is here. There's nothing we could do about 2016 taxes, but let's make sure we don't miss next year. Get busy on the tax planning. Thanks for tuning in, my friends. Have a wonderful week. Happy Easter. We'll see you again soon.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com.